Hello, everyone. Welcome to the next webinar that APM is presenting in collaboration with the CME Group. Very pleased to have you here. We also have Brannigan Barrett, who will be doing the presentation. Just wanted to welcome you again. This is the second of 3 webinars that we're presenting, and the first one was very well received, and looking forward to this one and the next one, which will be on the 2nd of May. Those of you who are new to APM Capital, we're a regulated brokerage in Abu Dhabi, and we offer our clients foreign exchange and CFDs, and we also connect them to the world's derivatives exchanges. The biggest and the best being the CME Group, where we do a lot of business, and we're happy to have this partnership with them. If you do have any questions during the presentation, please drop them into the chat, and Brannigan will come to those at the end. So we'll run for about 45 minutes, and then we'll have about a 10-minute Q&A session. So let me just introduce you to Brannigan. If anybody wasn't on the first webinar, he is the founder of Habitus Capital, which is a boutique investment firm specializing in futures trading. He has over a decade of experience in futures trading, and also founded a company called Tradelo Trading, which is a company dedicated to developing innovative trading tools for retail traders. Brandon has contributed hundreds of hours of educational content on YouTube, enriching the trading community with his insight and expertise. So without further ado, please allow me to introduce Brannigan, and I hope you enjoyed the webinar.
Good morning. Thank you, Mark, for that introduction. So welcome, everybody. This is then part 2, as Mark has said. And what we're going to do today is we're going to go over pretty much exactly the same sort of structure as last week. And we're going to start off and talk about 2 key trading principles. I'll then move on to the second risk strategy. So last week we spoke about the equal risk weighting strategy, and this week we're going to talk about the ABC risk strategy. And then we'll move on to some market narrators. We're going to talk charts, we're going to talk trading opportunities. I'm going to show you a few key, very interesting things that you want to be paying attention to, particularly because they are current at the moment in the markets. And then, like Mark said, we're going to move on to some live Q&A. Now, the markets we'll cover, I will cover the most liquid CME futures products, including the S&P, crude, gold, and Euro FX. And because Bitcoin is fun, because it's something that I do like to keep a very close eye on, it moves around a lot, we will cover that when it is relevant. At the moment, Bitcoin, not quite too much happening there, but when it becomes relevant, there's something to talk about, we'll move on and include that in the webinar. Now, today's quote: process saves us from the poverty of our true intentions. If you were on the part 1 of this 3-part series, the question came up in the Q&A about, do I think process is important for traders? The reality is that process does save us from the poverty of our true intentions. And what this quote means is that essentially it implies that we adhere to a structured approach or method, because when we follow some form of a structured approach or method, it acts as a safeguard. Okay, it ensures that we don't allow our personal biases, our misguided intentions to ultimately influence our decisions and actions. Okay, now the way to think about this: imagine someone has a goal of getting in shape and they want to improve their overall health. At the end of the day, they will struggle due to inconsistencies, because once that motivation starts to disappear, they'll make those mistakes that we all typically make. Okay, when we have that structured approach in place, when we have that process in place, that sort of step for step that we can follow, ultimately this safeguards us. Okay, this ensures that we get beyond that sort of initial "I'm motivated to be healthy and exercise." It makes sure we get beyond that. And most importantly, if we can stick to it for long enough, if we can follow that process for long enough, we'll get to the point where we actually start to see some results. Okay, and that's what this quote is all about. It's all about when we have process, it will save us from ultimately what we truly want to do, which is not follow a process because it's hard and it's not natural. Okay, so where are we going to go today? We're going to talk about 2 key trading principles: how to determine the daily stop. Okay, something that no doubt all of you at some point in your career have thought about. At some point you have wondered, how does a professional trader ultimately determine their daily stop? And then the second topic we're going to talk about is how to take more winners. Okay, now the best place to start today is with, like I said, topic number 1, How does a professional trader determine their daily stops? Now, this is probably one of the most important topics that we must cover as professional traders. And it comes down to, very simply, what are your trading objectives? Okay, what's out there currently is, if you go online, you type in Google, or you try and search for something like this on YouTube, what you're going to get is a typical risk 1% of your account, or have an equal dollar amount of $100 per trade, something along those lines. Very simplistic, very sort of almost overly simplistic in nature. Now, how you determine a stop has actually got everything to do with your trading objectives. Okay, and this is where most traders sort of come unstuck, because very few traders actually have got objectives other than, I just want to make money. Okay, unfortunately, I want to make money is not a trading objective. And the way you want to think about this, okay, is that the risk profile, or the daily stop of a trader that wants to take an account of $10,000 to $20,000, that risk profile is very, very different to a trader who wants to take an account from $10,000 to $100,000. Okay, and we'll talk about those two different trading objectives in a moment. But what are some of the trading objectives that you must consider, that you want to have a think about after today's webinar? Well, first and foremost, are you doing this as a full-time career? Okay, do you want to be a full-time trader or not? Or are you just doing this as passive income? Okay, do you want very little volatility in your equity curve? Do you want to double your trading account? Do you want to make a 7-figure £1 million day? The reality is, depending on what your answers are to some of these questions, that's how you're going to determine your daily stop. Okay, it's got nothing to do with what's comfortable and uncomfortable. It's got everything to do with, what do I need to achieve? What am I setting as the goalposts? And then, based on that objective, based on what I'm saying I want to achieve, I then need to go and set my daily stop based off of those objectives. Okay, now, the way to think about this is to just come back to some basic math. Okay, this is how daily stops are worked out. You work it out in basic math. Let's say your objective is, I want to take a trading account from $10,000 to $20,000. Okay, is this possible? Is this feasible? 100% yes. Okay, you can do this. It happens quite regularly for professional traders. And what it comes down to is simply working out that if I have a $10,000 account and my return goal for this year is 100%, how much dollar-wise do I need to make on average every day? And what it boils down to is, I need to make $45, or call it $46 a day on average every single day, in order to achieve this objective. Now, I'm sure we can all agree that this is a relatively holistic goal and very achievable. We can all agree that. I think basic math says, well, look, $46 a day is not that difficult to make. If I was to, for example, risk $100 a day, 1% of the account per day, ultimately, that is quite a feasible goal for most traders. Okay, now, if it's so feasible, why are so few traders capable of taking an account from $10,000 to $20,000? Well, there's two simple reasons. Most traders don't want to make just $46 a day, because in reality, if you make $10,000 a year as trading profit, that doesn't factor in any expenses or wages. So in essence, you'd be working for nothing. Okay, and it's something traders just cannot accept. The second reason so few traders can actually achieve this simple objective is because what typically happens is that traders aim for much higher returns. But in order to make these higher returns, there's only two ways to make higher returns. One, you either have to make bigger winners, or two, you have to increase the position size. In other words, leverage more. Okay. Now, with limited experience, all it takes is one over leveraged trade to go wrong, and then all of a sudden we have that big drawdown. And then all of a sudden, if I've lost $1,000 in the day, how many days is it going to take me just to get that drawdown back? Okay, and those are the two key reasons why so few traders can actually, or why so few traders fail to achieve what is mathematically something very, very simplistic. Okay, now, the key, and what I want you to take away from this, is that when we have an objective of, I want to take my account from 10 to 20,000, I therefore need to make an average of $45 or $46 a day. The key takeaway is, what percentage of my account should I be risking in order to achieve this on a daily basis? Now, for most traders, what I like to work with, remember, this 46 is an average. Okay, you're not going to make $46 every day. You have to factor in that you are going to lose on some days. But the key here is to do a multiple of 4. Okay, so most traders typically, okay, they would need to risk 4 times their average target, in essence, as a daily stop. In other words, to achieve this goal, you would need to risk $200 per day as a daily stop in order to get an average of around $45 or $46 on average. Okay. Now, the key, and this is what I want you to understand, is that if you can just accept this daily stop, if you can just say to yourself, I will never allow myself to blow through this daily stop, I'll never allow it to go to minus 220. If you can accept that, ultimately, you'll never have a spike in your average daily loss metric. Okay. And this is where most traders go wrong. They don't accept the losing days. So instead of just losing the $200, they'll lose $600. Now, remember what I said to you. If you're setting a target average of $46, and you were to double the loss. Okay, so let's assume you lost $200 today. That's 4 days of work in essence. Now, if you were just ill-disciplined and you lost, that now suddenly becomes 8 days of work. Okay, and that's the real key takeaway. It's not so much, just setting the right kind of daily stop, but it's actually adhering to it. If you can do that, and this is where risk management is so key, if you can do that, what ends up happening is you remove the volatility from the equity curve. Okay, so you get a much sort of obviously shallower curve, but it doesn't have deep drawdowns. Okay, loss acceptance is key to reducing the volatility in your equity curve. Now, let's compare that. Okay, so we took an objective, we said 10,000 to 20,000. It's feasible, it's doable. In order to do that, ultimately, we need to make $46 a day. Therefore, as a result, our daily stop must be $200 or 2%. Okay, so we're risking 2% of the account in order to get to our stated objective. Now, let's do 10,000 to 100,000. Okay, because no doubt some of you have got an absolute objective of, I want to make a lot of money. And by the way, that's absolutely fine. In a minute, I'm going to share an example with you of some even crazier objectives in this. Okay, the point is that, again, we need to follow a mathematical approach, a logical step-for-step approach in order to determine how we can get to this point, or at least what daily stop do we need to follow. Okay, now, again, is it possible to take a $10,000 account to $100,000? Yes, I've seen it. Okay, I've seen it many times in my career with many traders. Okay, the point is, again, we're going to need to achieve a $460 average P&L per day, which means now our daily stop is $2,000 per day. Okay, now we can all do some basic math and see, well, that means we're putting at risk 20% of the account. Now, does that make sense to most of us? No, of course not. Okay, it's definitely a recipe for most people to bin an account. That's pretty much almost guaranteed for most traders. Okay, but what I do want you to understand is that it doesn't necessarily mean it cannot be done. Okay, now I'll share an example with you. I know many prop traders that will at some point over a year, possibly a couple of times a year, put about 50% of their trading account at risk. Now, don't get me wrong, these are very calculated bets. They're very targeted bets, but 100% they could go wrong. Okay, but the reason traders do this is because their stated objective is, I want to make £1 million day, not £1 million year, £1 million day. In order to do that, they have to put a significant risk to the account into the game, okay, into the markets. That's just how it works. Okay, so very, very important you understand is that there's no wrong or right when it comes to choosing your account balance. What I would say, if you're earlier on in your career, you need to be following some sort of a structured approach to determining that daily stop. Now, as a baseline rule of thumb for a daily stop, most objectives can be achieved while safeguarding the account with a 2 to 5% daily stop. Most, okay? So unless you have a crazy objective of making £1 million day, okay, most of you, a 2 to 5% daily stop is more than sufficient to achieve most of your objectives. Okay, with less experience in the markets, you want to be leaning more towards the 2% side. With more experience, more towards the 5% side. Okay, and it goes without saying, if you want bigger account returns, you want to make more money, you're going to have to put more of your account at risk. You cannot expect to make 100% returns just risking 1% of the account, because the reality is the law of probabilities, the law of basic math will not allow for it. It just doesn't add up. Okay, now a final note on trading objectives, there's no wrong and right. Okay, the most important thing is set your objectives. Once you've set your objectives, work backwards from there, determine that daily stop, and then stick with it until you achieve that desired objective. Okay. Now, this brings me to the next topic of today, which is this idea of, if you want to make more money, you need to have bigger RR, or you need to have bigger targets. That's absolutely false, okay? There is, unfortunately, this marketing idea that, to make money as a trader, you need to take big RR. And what I mean by big RR is big targets. Okay, you need to have 3 times your risk, or 4 times, or 10 times your risk, and that's how you make money. The truth is that's not true. Okay, if you've ever done a back test and you've looked at statistics and you look at data, what you'll notice is something that you can see in front of you. It's a probability curve in essence. And what you do ultimately is you go and have a look at, as I'm increasing the target. So let's say, for example, I'm got an ES 500, S&P 500, and my strategy, I want to target 10 ticks. Okay. And you go and have a look at what is the probability of you being capable of hitting that target for a strategy. What you're going to notice is as you increase that target from 10 to 20 prices, the rate of success, or at least the probability of you hitting that target before being stopped out, starts to diminish. Okay. And when we go from 20 to 40 prices, it starts to diminish quite aggressively. In other words, there's quite a significant rate of change in the probability of hitting that target. Okay. And this is statistically true for almost every single strategy I've ever seen. Okay. And that's why it dispels this idea that you need to take bigger targets. You don't need to take bigger targets. That's false. Okay. What you need to do, sure, you need to be optimal in terms of where you place your stop. You need to be optimal in terms of how you enter a trade, because you control your stop placement. You control your entry price. You do not control the target. Okay, you simply just have a hypothetical idea of where a market should go. The market ultimately determines where price will go, not you. Okay, so you cannot try and fix the target. You simply need to optimize on entry and stop. But in saying so, once you've optimized on entry and stop, you need to choose a target that ultimately is probabilistically going to trade more often than not. Okay, but to make more money, it's not about a bigger target. Definitely not. What it is about is that I'm trading 1 lot. Now I need to be trading 2 lot. Now I need to be trading 3 lot. In other words, if on my trade, I typically make $100 with 1 lot, when I take the exact same trade with the exact same target, now I'm making $200 with 2 lots. And when I take it with a 3 lot, now I'm making $300. That is how you make more money. It's got nothing to do with bigger targets, but everything to do with increasing position sizing. Okay, let's now talk about risk management strategy, ABC. Last week we spoke about the equal risk weighting. This week we're going to talk about ABC. It's a favorite amongst professional day traders. Why? Well, you'll see in a minute. Okay, now what problems does risk management solve? Over leveraging. Okay, like I said to you earlier on, if you can just avoid taking a bigger loss than $200, you'll make your life a lot easier. You'll smooth out that equity curve. And it comes down to risk management. If you manage a risk, you're not going to over leverage. Okay, equally, as a byproduct, you won't overtrade. When you're managing risk, you're thinking about risk. You're actively stopping yourself to say, I need to think about what position size to establish. And what that means is you typically have a second or two more to recognize, oh, I'm being sucked into the volatility. I'm starting to overtrade. And that just gives you a chance to pull back. Okay. Risk acceptance. When you're managing your risk, when you're thinking about risk before placing the trade, guess what? You accept the loss. You're not fearful and emotional of that loss because you've thought about it before you've even put the trade on. Okay, like I said to you, if you have a $10,000 account and you recognize that if you get this wrong, you're going to lose $50, you will very much take that risk. You won't lose any sleep over it because it's $50 of a $10,000 account. Okay, the point is when we think about the dollar loss, the acceptance of how much we're going to lose, there's zero emotion involved because we've already accepted it. Okay, and then finally, like I said, we remove the setbacks. And this is crucial. Obviously, as you get a little bit further on in your career, momentum is something that plays a massive role in terms of trading. That sort of idea of trading in the zone, it comes a lot down to momentum. To maintain momentum, you cannot have setbacks. Okay, you cannot suddenly blow through a stop and have a double stop out day, because that does stop your momentum. That does kind of make you a little bit hesitant. So very, very important. Risk management solves you ever having those setbacks in the first place. Now, what is the ABC strategy? I'm going to go through it briefly, then I'm going to give you 3 examples. Okay, I'm going to show you how we use it and how you can start using it in your trading. So the math behind it. Take your strategies, all of them, from the best to the worst, line them up. Okay, so your best strategy, number 1, your second best strategy, number 2, and your worst strategy, number 3. Okay, line them up in terms of expectancy. If on strategy 1, I make $100 typically, strategy 2, I make $20, and strategy 3, I lose $35. You line them up. Okay. And the way you want to think about this, your A strategies are your best strategies. They have the most expectancy or the most likelihood of winning. Okay. Your B strategies, they're good strategies, okay, but they're not your best strategies. They're structured in nature. There's logic behind them. You know a lot about them. You've done a lot of them. And your C strategies are pretty much just your gamble trades. They're your trades that you pretty much lose money on, but you want to take them. You want to execute them because you feel like maybe you're learning. You feel like maybe you're engaging in the market, whatever it may be. Okay, so you list your strategies in terms of A strategies, B strategies, and C strategies. Now, you need to allocate. In other words, we spoke about a daily stop of $200. Okay. In this example, sorry, I'm going to use a daily stop of $500. Okay. So we use a daily stop of $500. And all we say to ourselves is, if my A strategy comes along today, for that strategy, if it happens to play out today, I'm going to risk $250 of my $500 on that trade because it's my A trade. Okay, so I'm risking 50% of my daily stop on that one trade. If my B strategy comes along, I'm risking $125 of my $500 daily stop. Okay, in other words, I'm risking 25% of my daily stop. And my C trades are effectively my worst trades, and I'm going to risk $50 of my $500 daily stop on those trades. Okay, so I'm allocating more risk to my best trades, and I'm allocating very little risk to my worst trades. Okay, and that makes sense because probabilistically we want to bet on things we understand. We want to bet on things where we've got some sort of asymmetry. We want to bet on things where we feel like we've got a guaranteed winner in play. Equally, why would we risk on gamble trades? Why would we want to throw away good money at trades that we like? We like the idea because we read a tweet on Twitter. Why would we throw good money at those things that we have got very little understanding? Okay, and that's why the strategy proves so popular for day traders, because ultimately our job is to trade, our job is to engage with the markets, and we want to make sure that we're allocating more risk to what works and what's good and less risk to what doesn't. Now, like I said, the way to think about this, your A strategies are the kind of trades where you feel like the odds are very much in your favor. Okay, as in, if you think you've got a 90% likelihood of winning on that trade, that's an A trade. Okay, it's almost an extreme. Okay, you don't see A trades all the time. They don't happen every day, possibly a couple of times a month. Okay, we've got asymmetrical skew. What do we mean by asymmetrical skew? In other words, when I hit the market, I'm very much going to go onside very quickly. Very little risk of going offside, very little drawdown on that trade, or what they call a sort of an unfavorable excursion, very much going onside. And when I do go onside, I'm going onside quite a lot. Okay, we'll talk about some of these examples in some of the a little bit later on. Okay, in terms of a B trades, those are your structured plays. Okay, they're plays that you understand, you know how they work, you know how to get in, you know how to get out. And then your C trades, when you're preempting, perhaps you don't have that much information, a little bit of a gamble trade, maybe you want a fun little scalp because, you know, whatever it might be, those are C trades. Okay, the key here is we take advantage of our best plays. Now, the example, okay, CPI came out last week. This was an A trade for most professional traders. Why? Because the month over month came out 0.1 high on the core and the headline. It was very much an outlier. The market was very much concerned about this. And as a result, this is where your entry price was. Okay, now sure, I'm not going to go into too great a detail. The point is that this is an outlier trade for professional traders. We want to be risking quite a high degree of our daily stop on this trade. We're entering there, and you can see there's very little. This is a 1 minute chart, by the way. There's very little price pressure against us. By the time we're entering, we're instantly on side, and we are looking for a relatively large winner before the market begins rotating. Okay, so in these trade scenarios, we want to risk a lot more. Now, a B trade strategy is something like a breakout strategy. Okay, you all have breakout strategies. These are structured plays. We know how to execute them. And this is the S&P 500 from this week. We can see we've got this little bit of a flag structure. We can see we've been consolidating from Monday, Tuesday. Yesterday afternoon, if you go look at the charts, you'll notice there was quite a high degree of absorption inside this candle. And all of a sudden, the market snaps, moves lower, and we drop from 74s down to 44s in about an hour, hour and a half. Okay, so a good 25-30 handle rotation. That was a structured B play. Okay, it's something we understand. We know where the stop is. We know what to expect in terms of characteristics. We know what we want to see in terms of volume. So we understand the play. And because of that, we want to allocate 25% of our risk to that trade. Okay, and then our C trades, and I'm going to take you through this a little bit later on, is when Brannigan comes out and says, look, the pound is about to get pounded and you want to be selling cable on any rallies now because we should be going down to 121. If you like the idea, you like the fundamentals, you like the technicals, but you don't really understand the play, or perhaps, you see it as something that, it's not really your A or B play. These are the kind of trades that we allocate C risk to. Okay, it's not that we don't take the trades, it's just that we want to allocate a lot less risk to them. Okay, so that is the ABC and methodology, and that's how we determine ultimately which trades we put on more risk and which trades we put on less risk. Now, in terms of advantages, disadvantages, the advantages is that we take advantage of high probability outcomes. Okay, when it's in our favor, when the odds are very much leaning towards us winning, we want to risk more. Okay, it's very much a dynamic approach, but it also allows us to take on more trade ideas and learn with engagement. This is key for so many traders. Often I hear traders say, sit on your hands and be disciplined. That's rubbish. Okay, you will only learn through applying yourself. You'll only learn through getting your hands dirty. Now, to do that, you've just got to manage the risk. Okay, which means engage in the markets, but do it so managing risk. Make it a C trade. If you're learning, learn through C trades. Okay, don't be putting on a risk for a trade you're still learning to develop. It's also a very flexible risk model. Now, in terms of disadvantages, it does require an advanced understanding. Okay, like I said, if you don't know your best and your worst trades, if you don't have some sort of idea of expectancy, you're kind of going to be flying a little bit blind here. All right. You also need to have some degree of back testing, and at least in terms of maybe not a formal back test, but perhaps you need to have done a trade 10 or 20 times to understand if it's good or not. There is also, of course, a risk of foregoing trade opportunities if there's insufficient risk. Okay, what I mean by that is if you've gone and taken a trade what you thought was an A trade, but it turned out to be a B trade, you've given away a large amount of your risk on the day, which means you may not be able to trade for the rest of the day. Okay, and then lastly, there is the subjective nature of applying ABC. In other words, if I go back quickly to the ABC, I've recommended 50% on your A's, your 25% on your B's, and 10% of your daily stop on the C's. But this number is discretionary. This is entirely up to you. Okay. For the professional traders I mentor, I normally start them off on something more like a 10, 20, and 40. Okay, it's a little bit more conservative. Make sure that they still have risk. But again, this is up to you to decide. If you want to risk 100% in your day on A trades, fine. That makes sense. There's logic behind that. But just be aware of if you risk 100% on one trade and it's all gone, you are stopped out for the day. Okay, that's the ABC risk strategy. Now, some key market themes. Market is doing the Fed's job. We'll talk about this in a moment with a nice chart. But what in essence has happened over the last 2-3 weeks is quite a lot. Since our last meeting, the market has told the Fed, well, look, you don't want to hike rates. You telling us you're going to cut rates. So we instead are going to push the yield curve. Okay, we've seen 2-year yields move up from the start of this year. 2-year yields have gone from just above 4% for around 4.1%, and 2-year yields are now trading just shy of 5%. Okay, so the market is doing the Fed's job. The market is tightening for the Fed. And this matters because if you go back to September last year, you will remember Fed's pal came out and said, look, the reason we're not going to be hiking again is because the market is doing the hiking for us. So there's no need for us to necessarily hike because the market has tightened already for us. Okay, same thing here. The longer rates stay up at these yield levels, the more that will start to feed into the real economy. Okay, a really important theme to pay attention to. We'll discuss that in the next couple of slides. Then growth expectations are driving earnings expectations. And this has been a key thesis as to why US equities are the massive outperformer. Why you hear Mohammed Al-Arian talking about exceptionalism, US exceptionalism. And it's got a large degree to do with growth expectations. Okay, what do we mean by that? Typically at macro level trading, every economy has what we call sort of an equilibrium rate of growth. Okay, it's sort of the rate of growth an economy should grow at. To do this, if you go get up the US GDP and you look back sort of over the last 10, 20 years, you go back and zoom out and just put a sort of a 5 or 10 year moving average, okay, you will see let's take, for example, GDP of around 2.5%. Okay, and this is effectively what we call the long run likelihood of growth in the US. Now, ultimately what's happened over the course of most of last year and this year is because of so much fiscal spending going on in the US, we are seeing growth expectations, or at least what's happening in real growth sort of outstripping the current sort of long-term expectations in essence. Okay, so US growth is growing well above what's expected, and as a result of that, Okay, equity markets are saying, well, look, if growth in the US is exceptional and it's well above average, it means that corporations' earnings should be well above average as well. Okay, because if you're growing more, by definition, companies should be earning more. Okay, and that's what's driven ultimately a part of the thesis as to why equities have rallied so aggressively since October. Now, why am I mentioning this? Because the key for us as traders is often we get sucked into the charts. Okay, what we must never forget is that these long-term trends or these reasonings behind why markets trend have got big macro fundamental drivers. And the key driver is that US growth is outperforming. As a result, earnings expectations are outperforming. And so long as that stays the base case, that thesis remains intact. Okay, and what that means is that we are very likely to still get a new record high this year again in US equities, so long as, and this is the caveat, so long as growth continues to outperform. Okay, if the US economy stays strong, if jobs in the US economy maintain the strong growth we're seeing, and we continue seeing all this really positive data from the United States, the reality is equities are going to be making record highs again at some point this year. Okay, and until further notice, you've got to keep that cap on because you don't want to be bucking the trend. You don't want to be suddenly being that guy that wants to short it because it's gone too far too fast. Okay, that's not a strategy. Ultimately, that's not something in the long run that's going to make you money. Okay, then the ECB and the BOE are cutting before the summer, but the Fed is on hold until they're more confident. We'll talk about this in a chart in a minute. And finally, the dollar spells trouble. Okay, we'll talk about this in terms of the yen. The dollar really is sending a strong signal, and it's something you need to be switched on for because it's going to have ripple effects. Now, let's start off and talk about the differential. So I told you the ECB and the Bank of England are going to cut before the summer. The Fed is going to cut after the summer. They obviously would like to cut before the elections in November. Most likely September is the starting cut. But Powell told us this week that the recent data is not giving them more confidence. And if anything, they may need to keep rates higher for as long as needed. Okay, now that doesn't mean they're not going to cut. It just means they're unsure about when they're going to cut. Whereas Bank of England has told us just yesterday, BOE's Bailey told us, look, inflation is going to come down very aggressively next month. And as a confidence booster, we think we're going to be able to cut rates pretty soon. Okay, the ECB has told us June they are going to cut. So the ECB and Bank of England are quite certain in their rate cuts. The BOE most likely is going to cut in May with the ECB in June, and the Fed is uncertain. Okay, could it be September? Well, that's what the market thinks. The market thinks we still get 1.5 rate cuts this year. But right now, there's uncertainty. Now, what that means is ultimately we're going to get divergence. Okay, we got divergence between policy paths. And whenever we get policy path divergence, you want to be switched on because what you'll get in the currencies is a lot of volatility and volume. Okay, if you traded currencies for most of last year, you'll see nothing happened. Okay, they really did do nothing. And you can see that. I mean, this is ultimately, the 2023. You can see this is cable, was sideways for most of the year, had a bit of a rally, came back and did nothing. Okay. However, this year, what we've seen is ultimately, sorry, that's not last year. This is last year over here. Okay. This is last year. So we can see cable move sideways, had a little bit of a rally and came back. Okay. However, what's happened, and I want to pay your attention to the green line. Okay, the green line is in essence the differential. So we take the spread between US 2-year yields and the spread between UK 2-year yields. Okay, and we use this to ultimately create a differential. What is the difference between what I can get if I owned US 2-year bonds versus what is the yield I can get if I owned UK 2-year yields? Okay, now as the spread widens, in other words, the US provides me with a wider yield relative to the UK. What in essence happens is the currencies are directly correlated to that. Okay, and what you should expect to see, because we now have this divergence between the United Kingdom or the Bank of England and the US Fed, what we should start to see is that pound move down quite aggressively. Why? Well, because the UK has told us they're going to begin cutting rates, and the US has told us ultimately they are going to keep rates as is for now and as long as necessary. Okay, so keep a very close eye on that. Couple that with the fact we have broken below, 6-month support. Okay, we're now below 125. The market's confirmed that break. We had some good volume and volatility through that break. Right now, cable is very vulnerable to a move down to 120 over the next couple of days and weeks. Okay, keep an eye on that. Now, policy error. What do I mean by policy error? Policy error is where the central banks decide they're going to take a certain sort of stance. And right now, the Fed has told us they are ultimately dovish on inflation. In other words, they've told us that they'll accept higher inflation. Okay, they've explicitly said that right now they would rather have the soft landing. They'd rather have a strong, robust economy and accept inflation comes back to target as only in 2026. Okay, so what they're telling us is that, inadvertently, yes, their mandate is full employment and inflation, but what they're telling us is they're now prioritizing full employment over inflation. Okay, now what that means, and this is key for gold has told us that, well, look, if you're going to do that, ultimately you are going to ultimately accept a higher level of inflation. And we know that gold is an inflation hedge. However, the Fed has also told us that they will not be afraid to begin the process of cutting rates. Okay, and that's why we got this massive acceleration in the gold, from March, was because the Fed told us, look, we're quite comfortable cutting 3 times this year, starting in June. Okay, and as a result of that, gold has taken off. Now, what is a policy error? How do we know that we're getting a policy error? Well, if we look ultimately at the US 10-year yields in purple here, what we can see is that US 10-year yields have moved from 410 to 460, so 50 basis points up in the last 3 weeks. Okay, and this is a result of the market telling the Fed, if you do begin the process of cutting rates, if you do decide that you're going to safeguard the economy and employment over ultimately inflation, we obviously need to reprice things. We need to have a higher risk premium. We need to accept that inflation expectations and break-evens are higher, and therefore the US 10-year yield needs to be higher as well. Okay, and that's what the market is sending to the Fed. They're telling the Fed, look, it's fine if you want to prioritize it, but factor in you are going to need a higher yield. Now, if you go back to last year and we look at March, we all remember the banking crisis. That was a result of higher yields. Okay, we also know that the US Treasury has got a bit of a funding issue where they've got massive issuance. And if yields are high, they're going to have to issue bonds at much higher yields. Okay, so they're just increasing the amount of debt that needs to be paid back. So there's a number of spillover effects that come from this policy error. Okay, keep a very close eye on particularly the yields. Why? Should we get back to 5% in the 10-year Treasury? Remember, and this is key, there are very few people on the street. When I mean the street, we're talking about, the US street in essence. There are very few people that believe yields will get above 5%. Why? Well, because they believe that the US economy cannot sustain yields above 5%. Okay, now, if that's the belief that we cannot get above 5%, it means that everyone is long bonds. Okay, equally, since December, when the Fed pivoted and they came out and said the next step is rate cuts, since then, notice what we saw in yields. We saw a very aggressive drop-off in yields. Why? Because everyone took the bet that the next step is rate cuts. So if there's this belief that rates cannot go above 5% and everyone is long bonds or short the yield, as you can see here, in essence, the consensus positioning is to be long bonds. Now, if this continues to move up higher, it's going to test that consensus positioning. And when I talk about the street, we're not talking about small positioning yet. Okay, no one believes we'll get to 5%. And what that means is that no one believes we'll get to 5.5 or 6%. So should we get to 5.5, 6%, they're going to have massive ripples for the markets. Okay, keep an eye on that. Now, this is another chart to pay attention to. This is just the US 2-year yields. Okay, so in orange, you've got US 2-year yields, and you can see the March crisis there. Okay, that's the March crisis. You can see 2-year yields rallied very aggressively into March. We then had the banking crisis. Okay, as a result, the market said price in a recession, and that's the drop off of the 2-year yields. Then everything started to calm and restore. Yields went back up higher. Why? Because the Fed was still in a hiking cycle. Okay, fast forward to the middle of last year. What did the US equity market do when yields got back up to that 5% 2-year yield? Well, this is the US equity markets in green. You can see they underperformed. We had a really aggressive, almost a 9-10% correction in US equities over 3 months because of that higher yield environment. Okay, and this is why the yields are key. If you look at where we are now in terms of the 2-year, you can see we're right back to that 5%. Like I said, we were trading 4% just 3 months ago. We're now at 5%. Should we get above 520, the US equity market is vulnerable to a deeper correction. Okay, very, very important to pay attention to those yields. Now, the right environment. This is something that's cropped up this week on our trading floor. It's all about the VIX, okay? And I just want to teach you a little bit about the VIX, talk a little bit about VIX inversion and regime change, because this is key to understanding the right environment to buy dips, okay? So one of the voice notes we put out today was all about, is today the right day to buy dips in the US equities? It seems so. The environment seems a bit more constructive to stand in the way now and start to look to be a dip buyer. Remember what I said to you? The consensus thesis this year is that so long as US growth outperforms, we should be back at those record highs at some point. Okay. Now, what you'll notice is that over the course of Friday last week, Monday, Tuesday this week, we got this VIX spike. Okay, so this is the VIX in purple, we got the S&P 500 in orange, and we got the VIX spread in green. Okay, now what you'll notice is that as that VIX spike came in, we finally started to see a little bit of profit taking in this very aggressive rally in the S&P 500. Okay, at the same time, you can see in the red line here on this chart, that's just a moving average, and it's something I suggest traders always add to their chart. Go and add a 10 or a 20-day moving average onto your VIX, because what it signals to you is what is the current average regime of VIX or volatility for the US stock market. Okay, and what you'll notice is that when it flatlines, ultimately, it's a very constructive environment for risk markets. However, when it very aggressively gets steep, we can see obviously that's not a very conducive environment for risk markets. Okay, so the regime in which the VIX is very, very important for how equities trade. Okay, now what I wanted to mention to you was also the VIX spread. You will notice over the course of the last 3 years, we've had an inversion in the VIX spread 3 times. In 22, we had it twice, and then at the end of 22, we had it a 3rd time, and we haven't had it since. Now, the VIX spread is nothing other than looking at 1-month VIX versus 3-month VIX, and all it shows us is when there's a very high degree of uncertainty. Why? Because people are willing to pay a lot more or a higher price for immediate protection versus longer dated protection. Okay. Now, when this typically happens, when we have a VIX inversion, it will always occur with a much higher level of absolute VIX. Okay. Moreover, when we have these periods of VIX inversion, that's a very negative environment for the S&P 500. It's an environment in which you do not want to be buying dips, because that sort of environment is ultimately always going to sort of suffer setbacks. Okay, so keep a very close eye on that. We did briefly invert Friday, Monday this week. We've come out of that inversion. The VIX has started to crush back down again, which is why we are very constructive at buying dips, particularly today, tomorrow in the S&P 500. Okay, dollar index, just briefly bring it to your attention. What you can see, the dollar is the key player. Okay, it's something you have to pay attention to. Why? Well, like I said, Bank of England and ECB are confident they're going to go before summer. Fed doesn't know when they're going to go. The result, okay, this is what ultimately the DXY or the dollar index has done over the last 4 or 5 sessions. We've very aggressively broken to new highs for the year, and we're now right back up towards those highs of last year. Okay, now why does this matter? Well, because everyone borrows in dollars all around the world. Okay, when the dollar rallies, it has got ripple effects. Now, so long as the Fed remains uncertain about when they're going to hike, so long as they remain higher for longer, the dollar is going to continue higher for longer. And why does that matter? Well, yesterday we had some intervention. Okay, the United States, Japan, and South Korea agreed to consult closely on foreign exchange markets. Why? Because the yen is hitting 34-year lows. Okay, this matters. Why? Because the yen is used as a funding currency. Okay, everyone typically has always used the yen as some sort of a carry trade. And obviously, the Japanese are very big buyers of US treasuries in essence. So when we see some significant weakness in the yen, it does create a number of ripple effects. And what we can see is that since in the purple, this is the US 10-year yields, since those US 10-year yields have begun that march up since the start of the year, we can see that yen has also begun that continuation or that weakness. Okay, equally, where is the yen? Well, it's now broken out of a 2-year high. Okay, and it continues to weaken. We are at 34-year lows, and typically, these things don't end well. Okay, typically, when ultimately a currency weakens to this degree and this sort of speed of weakness, intervention is not going to be enough. Okay, what the market typically does, and this is key to understand, the market typically forces the central bank. What do I mean by that? Well, the market's going to keep selling yen and buying dollar. Why? Because the US has got higher interest rates, and Japan's got 0 interest rates. Okay, yes, the Japanese have told us they are considering hiking, and maybe they hike, maybe they don't. But in reality, until the central bank hikes, the market's going to keep pushing and pushing on yen weakness until such a point that the Bank of Japan either intervenes in the currency directly or ultimately hikes their interest rates and closes out that differential. Okay, so keep a very close eye on the yen. It's not something you want to be fading. You definitely don't want to be long of yen. You definitely want to be looking to be a buyer of dollar and short of yen, and just keep a very close eye. Okay, this is the kind of market that we could get a very illiquid event at some point in the next couple of sessions. And like I said, that will have some ripple effects for some of the other markets. Okay, and then finally, our index. Okay, this is a rebalancing index. I showed you this last week, but often I hear traders say to me, which index in the US should I trade? Should you be trading NASDAQ? Okay, you've obviously got access to NASDAQ futures. You've got Russell futures. You've got S&P 500 futures. You've got Dow futures. Which one should you trade? It's simple. You always want to be a buyer of a strong market, and you always want to be a seller of a weak market. A mistake I see from so many traders, and I'm sure many of you have done this, so I'm going to use an example. You'll see a stock that is sold off 80%, and because it's sold off 80%, you think it's cheap. And you'll see a stock that is not sold off at all, and because it hasn't sold off, you'll think it's expensive. In reality, there's a reason the stock is cheap, and there's a reason the stock is expensive. Okay, it's expensive because everyone wants it, and it's cheap because no one wants it. So you have to have that same sort of mindset. Buy strength, sell weakness, not the other way around. And that's why we use rebasing indexes. Okay, what you've got here in front of you in red is the S&P 500, in turquoise is the NASDAQ 100, and in gray is the Dow, and then in black is the Russell. And what you can see this year is that the best performing index is the S&P 500. It's up 5.3%. The worst performing index is the Russell. It's down 4%. Okay, there's a 10% difference between the S&P and the Russell. So I don't want to be a buyer of Russell. I want to be a buyer of S&P. Once the equity markets settle, we want to be buying S&P back for record highs, not Russell for record highs. Equally, if we see some volatility pick up, if we see a continuation of the sell-off in equities, we want to be selling Russell, not selling S&P. Okay, sell the weak market, buy the strong market. Finally, some key career lessons. Let's finish off. You have to be capable of seeing objectivity. This is something that took me probably 3 years in my career. I was the typical trader that read a newspaper, and because they told me Apple was doing record earnings, I would go and buy it. Okay, so the reality is that's not objectivity. Objectivity is ultimately being able to see facts, being able to understand the data, being able to trade with the price. That's objectivity. Okay, it's not trading off of ideas, it's trading off of facts. Okay, it doesn't matter how much work, time, effort, or energy and capital you invest, you've got to be able to see objectivity. Okay, it's key for the success of trading. Invest and trade what you understand. Okay, I've shown you a number of charts today. I've shown you the dollar, I've shown you the yen, I've shown you the pound, the euro, a number of different charts. You've got to trade what you understand. Don't step out of your lane. Okay, if you step out of your lane, the reality is make sure you do it managing risk. So use that C trade, don't use that A trade. When you start small. Keep your risk managed whilst you pay for the lessons. Okay, trading is not something you do for 1 year. It's something you do for 50 years. Think Warren Buffett. He's done it his entire career. If you want to trade and you're going to put your money in the markets and you want to learn this game, accept you're going to be around for the next 50 years. And in order to survive for 50 years, you're going to have to start small. Finally, and this is my favorite one, it's something I remind myself of all the time, don't compound on errors. Okay, you all make mistakes. That's a fact. You can never avoid mistakes. The most important thing is when you do make a mistake. Okay, so let's say, for example, I've hit my daily stop. I've traded poorly today. I've not really been focused. Don't go and compound that error and keep trading. It just doesn't make sense. Compounding errors will never, ever work for you in the long run. They'll always work against you. So simply don't compound an error. Okay, that's then a wrap, guys. Thank you very much. And yes, if you have got any questions, please do post them in the chat box, and I'll hand over to Mark now.
Thank you very much, Brannigan. That was really good. Again, another really good one. We do have a question already from Armin. Welcome back. The Federal Reserve aims to decrease inflation, yet with oil prices rising this year, inflation may rebound. Does this suggest the Fed might raise rates further to combat inflation? If so, how might this impact gold indices and stocks?
Yeah, I think that's a very good question. I think one of the things that you must understand, and this is again, unfortunately, when we sort of lend our ears to social media land, there's this idea that because maybe inflation's higher, the Fed needs to hike. That's not entirely true. There's what we call sequencing. Okay, so how sequencing works in essence is inflation right now is hot. It's not coming down. So the first step the Fed takes is they don't tell us they're going to hike. They just tell us they're going to keep rates higher for longer. Okay. The next step the Fed will tell us is that they won't hike this year. Okay. So that's part 2 of the sequence. They don't tell us they're going to, the next step the Fed says is they're not going to cut this year. Okay. So that's part 2 of the sequence. Once they've told us they're not going to cut, if inflation keeps coming out hotter and more aggressively, the next step is in the sequence is the Fed tells us they may need to increase rates further. Okay, they're not hiking. They're just telling us they may need to become more hawkish on inflation. The fourth part of the sequence is, oh, actually, we have an inflation problem. We're hiking interest rates. Okay, so there's a sequence of events. So in other words, the short answer to the question is the likelihood of the Fed hiking again is very, very, very low. Okay, that's not even in anyone's base case. You can probably assign less than a 5% likelihood of that happening. What the Fed would rather do instead is just keep rates at higher levels, allow for a longer period of time for the existing rate hike cycle to feed through to the real economy. But like I said to you, remember, the Fed doesn't need to hike rates for things to be tight. The yield curve, like I've showed you, has actually done the job for them. Okay, so that's what makes me think the Fed won't do anything because the yield curve's ultimately tightening it for them. Okay, 2-year yields were at 4% at the start of the year, and now at 5%. Don't forget, when you borrow money in the US, you don't borrow at the rate of the Fed, you borrow at the yield curve rate. So if you're doing a 30-year mortgage, it's linked to 30-year rates. Okay, so just keep that in mind. The market is doing the tightening for the Fed. But in terms of the answer of your oil price question, sure, oil prices do matter. I was actually going to talk a little bit about oil today. I think we can talk about that next week. But what we're seeing in oil is a very interesting market. Okay, oil did rally. We broke out, sort of 4, 5, 6 weeks ago. But ever since, oil's been quite weak. Okay, if you think about ultimately all the geopolitical risk that's been going on, oil's actually down 4 or 5% this week already. Okay, and that's with the fear and risk of what's going on in Israel and Iran in the Middle East. So to answer your question, I think there's something bigger at play in oil right now. There is, if you look at the week over week inventory builds, they are steadily increasing again. So what it suggests in essence is that we are starting to see a weakening demand for oil. Okay, and that's why central banks they have told us as well, and this is the key, hopefully that answers your question. It's not about where oil price is in terms of absolute levels. It's about where oil price will be averaging over the course of the year. Okay, this is how central banks work. They don't look at oil day to day. They look at it as our forecast for oil is $70 a barrel this year. How are we trading within that forecast? Okay, so it's not that it causes a problem for them in the near term. It's when the actual price of oil over the entire year is substantially higher than the forecast. That's when there's inflationary concerns. So hopefully that answers both parts of the question.
Good stuff. Thank you. Another question is, how do you manage risk during news events?
Okay, very good question. Yeah. So predetermined, that's the first thing. Okay, I think there's a bit of a belief that you shouldn't trade risk events. I'd argue that the best trades are risk events. You look at most trades in the last 2, 3 years, they've probably made 90% of their revenue from trading risk events, whether that's central banks, whether that's inflation, whether that's non-farm payrolls. You don't want to be standing out of the way of those events. You want to be trading those events. But the key is managing risk. Okay. Now, the 2 things you have to accept when there's a volatile event, you're going to have to first and foremost downsize on the risk because there's illiquidity. Okay, so there's not many people that are going to be executing over that data except for the algorithms. So you're going to naturally have wider stops. But equally, preparation is very, very important to it. Okay, I said last in part 1, I'll take you through setting up for a risk event. I think part 3 of this webinar, we're going to go through a risk event. We will specifically deal with trading a risk event, how you prepare for it, how you execute it, how you manage the risk. But the short of it is, risk needs to be predetermined. It needs to be event driven. In other words, if inflation comes out at 0.5, I'm going to use 2 lots. I'm going to have a 30 tick stop. It's predetermined. It's pre-thought out. So hopefully that answers the question. It's not about whether you trade it or you don't. It's about preparing for it. What are the trades you will trade? How will you manage the risk in those situations? And then executing that plan.
Awesome, thank you. And yeah, thank you from the question providers as well. They're very grateful. We have another one here. Would higher rates by the Fed lead to increased interest costs for the US government, potentially resulting in a decrease in the value of the dollar over time?
Again, probably something that is not necessarily something we want to go into too much detail. And the reason is don't forget, our job as traders is not to think about the next 3, 4, 5 years. Okay, it's to think about what are the risks in the absolute near term, what are the things that could create ripples, and what are the opportunity scope from that. So, look, a higher interest that a government needs to pay with an existing debt load of 130 odd percent. Sure, it's a problem. Okay, but is it a problem for today? No. Is it a problem for this year? No. Is it a problem 20 years from now? Possibly. So don't get too sucked into fundamentals that don't immediately matter but could matter in the long term, because you'll be all of a sudden shorting the dollar off of something that doesn't really matter, and the market's not really focused on it right now. Okay, when the market is focused on it, sure, if US 10-year yields are at 7%, different discussion. Okay, now then we can start to discuss them. We can start to discuss the implications of that. But in the near term, no, don't lend your ears too far out. Unless you are a long-term investor. Okay, if you're someone that invests in stocks in the long run, or you take 5, 10-year positions on things, fine. Okay, by all means, then that will probably form part of your framework. But no, not something you want to be too concerned about in the near term.
Okay, good stuff. Thank you. One of the things that I was thinking about when you were describing the potential kind of buying dips in US equities, like how far do you think they would fall, or what kind of correction do you think you would want to see, or is there something that you would want to see where opinion would change and you would say that no, we're actually seeing downward momentum that you would expect to continue?
Yeah, look, I think there's two ways to look at it. I mean, if you're asking me from a day trader's perspective, okay, there's two observations I made yesterday on the sell-off in equities. Okay, one was I was shorting the breakout. Okay, so I was shorting for that continuation. And what I noticed as a day trader is there was a very interested buyer there. Okay, I could see it on a number of the tools I use. Someone was very interested in buying it. Now, that for me is key as a day trader, because what it means is there are positions now from short traders. They're aggressive positions. They were positioning themselves after a 4%, 4.5% correction. And so that means they're vulnerable in the near term. Okay, which is why I'm constructively thinking we could get a 60-70 handle bounce today. It's just an unwind of those positions. Does it mean the correction's over? No, possibly not. So that's the first side. If you're asking me as a day trader, I'm constructive simply because I think VIX gets squashed today, and I think S&P should rally as a result of that. Okay. If you're asking me as a what is it that I can lean on to sort of make sure I don't enter the dip by too soon or too late, there's two things I think you can look at. One is very much a moving average, some sort of a moving average, simply because moving averages ultimately tell us a lot about the price dynamic and ultimately how far away the market has got from, I don't want to put any sort of hard rule on it, but a sort of a normal sort of price. Okay, so what typically moving averages are very good for, particularly in a trend move like we've seen in the US equity since October, is they do tell us when that trend has kind of come back to what's more normal. Okay, so a 20-day moving average or a 50-day moving average, I think that's something you can lean on. Not that you buy it. It's not that it hits the 50-day moving average, now you're a buyer. It's more a case of once it's reached that point, price is probably, that overboughtness of the market has probably corrected itself, and now the positioning is more neutral. So that's one thing you can look at. Another thing is Fibonacci's. I think Fibonacci's are pretty good for this, in a sense that, again, they just give you a relative degree of sort of pullback understanding. So, for example, from the October lows, if you draw Fibonacci to now, and you look at it, if we've only pulled back, I don't know, let's say, for example, 3%, you would look at that and say, well, that's very shallow. It's probably not really a correction. Whereas if it's pulled back, 20%, you'd say, okay, well, that's a pretty decent correction that the market's now done. But again, these sorts of tools, I never use them as, they're not a tool where I say I'm going to buy now because it's pulled back there. I think it's a little bit more nuanced than that. It's more just observing how is the market responding ultimately to certain price points. And so, yeah, that's how I would assess it from the two different perspectives. But just to make your listeners aware, I'm very much a day trader. So my job is assessing day trading flows. I'm not, when I say I'm constructively looking for longs today, it's not that I don't think it can go down 1 or 2% more. Of course it can. But I'm constructive because of very specific factors that I've observed over the course of the last few sessions.
Okay, good stuff. Thank you very much. Well, I think we've just about hit our hour, and so I'm sure conscious that people will want to move on. So thank you very much again, Brannigan. I really enjoyed that. I'm sure everyone else has as well. So thank you everyone for joining us. And I would like to just leave a word from our SEO, Mr. Nick Spencer-Skeen. Thank you very much.
Yeah, once again, Brannigan, thank you so much, and the CME group for putting this all together. Yeah, great. It's been fantastic, and we are back on the 2nd of May. So the discussion continues. I hope you all enjoyed it enough that you come back and join us again in 2 weeks' time. So for now, thank you very much. Enjoy the rest of your days, everybody. Goodbye. Thanks.